Building a massive cargo ship requires thousands of tons of steel, years of labor, and millions of dollars long before it ever touches the water. This creates a logistical gap. A single builder rarely has the upfront capital to finish a project of that scale, and they must convince thousands of strangers to part with their wealth today for a reward that might not exist until tomorrow. Finance bridges this gap using discounted cash flows. By taking all the cash a project is expected to generate in the future and applying a mathematical discount for the time and risk of waiting, we can compress those scattered payouts into a single present-day value. In the early 1600s, the Dutch East India Company pioneered a breakthrough by applying this logic to physical voyages. Instead of one person taking on the immense financial risk of a single ship sinking, they sliced the ownership of the entire fleet into fractional tradable pieces called shares. The moment people began trading these abstract pieces of future success instead of physical goods, the modern economic engine was born. Curious, analytical tone. Today, that entire global machine runs on precise mathematics, starting with a single, isolated buy and sell order. This order book stacks buyers and sellers in opposite columns, inching towards a central price line. The instant they agree, the system executes the trade. Multiplied by millions, when buyers flood in, demand pulls the price upward. When sellers flood in, supply forces it downward. This automated matching of bids and asks creates an efficient, emotionless foundation for capital exchange. But that perfect math constantly collides with global information. Every second, the system absorbs central bank decisions, geopolitical shifts, and corporate balance sheets, and humans have to process that information. Our brains rely on a dopamine-driven reward system and herd psychology, which often causes us to react to new data emotionally rather than logically. If investors panic over news, they aggressively dump shares. If euphoric about new technology, they buy relentlessly. These psychological reactions cause the asset's price to violently detach from its true mathematical value, triggering historical financial bubbles and sudden crashes. Human emotion transforms the exchange into a volatile psychological processor, where price discovery relies as much on collective mood as it does on mathematics. To strip out that psychological volatility, modern markets have largely removed human reaction times. They outsource the actual execution of trades to high-frequency trading systems, computer programs designed to buy and sell without hesitation. These algorithms scan the order book, analyze market depth, and calculate liquidity to make millions of independent trading decisions in a fraction of a millisecond. Achieving that extreme speed requires immense physical infrastructure. Financial institutions house their trading algorithms inside massive, temperature-controlled data centers located as physically close to the exchange servers as possible. In this environment, microscopic advantages in fiber optic data routing determine who executes a trade first, securing an immediate financial advantage. The market now functions as a globally distributed, autonomous nervous system, transacting at the speed of light through these interconnected server hubs. All of those lightning-fast digital matches ultimately exit the server racks to fund physical expansion. Companies use the capital raised on the exchange to increase heavy industrial output, build out chemical refineries, and scale raw resource extraction. That capital also buys the hardware required for automation, allowing manufacturers to install advanced robotic assembly lines and accelerate physical production. When a company goes public, the influx of investor cash directly finances the high-level research and development needed for technological breakthroughs. This ability to attract and deploy global capital for these massive projects is a key indicator of a nation's health. A high-performing, liquid stock market signals that the world trusts a country's legal and economic stability, translating its industrial capacity into global power. The digital ledger of the stock market provides the financial architecture necessary to build the modern physical world. That architecture is continuously adapting. Artificial intelligence is taking over data analysis to make capital allocation highly predictive, while decentralized finance models running on distributed blockchain networks aim to execute these trades without a central authority. This creates a hyper-efficient system that relentlessly merges human desire with strict mathematical execution. every fluctuating price point is millions of data points being analyzed, synthesized, and deployed to construct the physical future of human civilization.